For decades, Warren Buffett has regularly beaten the market by adhering to a set of principles and rules when making investing decisions. Buffett has managed to generate shareholder wealth of $600 billion and has given investors an average annual return of 20%. The total return from the start of 1965 comes to almost 3,300,000%. One of his most impressive achievements was generating a 30% annual return for more than 10 years, from 1957 to 1969, when he ran his own investment partnership. Buffett's investment checklist is based on his mentor Benjamin Graham's book, The Intelligent Investor, which taught him to look at stocks as slices of businesses that generate profits far into the future. Graham also taught him to focus on the intrinsic value of a business, which is the present value of all its future cash flows, and to buy stocks only when they are trading below their intrinsic value, thus creating a margin of safety. Buffett's investment checklist can be divided into 4 categories: business tenets, management tenets, financial tenets, and value tenets. Each category contains several questions that Buffett asks himself before investing in a stock. Warren Buffett's business tenets include investing in businesses with strong competitive advantages, a clear and understandable business model, and trustworthy and competent management teams. Buffett also emphasizes the importance of a company's long-term prospects and its ability to generate consistent earnings and cash flow. He favors companies that have a history of consistent earnings growth and that have the potential for continued growth in the future. Warren Buffett's moat refers to a company's sustainable competitive advantage, which allows it to maintain its market position and generate above-average returns over a long period of time. A strong competitive advantage that is difficult for competitors to overcome includes brand recognition, patents, network effects, economies of scale, and high switching costs. These factors make it difficult for competitors to enter the market or steal market share, giving the company a sustainable competitive advantage. Buffett believes that investing in companies with a wide economic moat can lead to long-term success and has often cited Coca-Cola as an example of a company with a strong moat. Coca-Cola is one of Berkshire Hathaway's largest holdings, with an initial investment made in 1988 and still holds today.
We bought our Coca-Cola, for example, in 1988 and 89 on this stock at a price of $11 a share, which as low as 9, as high as 13, but it averaged about $11. And it'll earn, we'll say, most estimates are between $2.30 and $2.40 this year. So that's under 5 times this year's earnings, but it was a pretty good sized multiple back when we bought it. It's the future that counts. It's like what I wrote there, what Wayne Gretzky says, to go to where the puck is going to be, not where it is. So the current multiple interacts with the reinvestment of capital and the rate at which that capital is invested to determine the attractiveness of something now.
Coca-Cola has a simple, consistent, profitable, and durable business. It sells beverages that people enjoy drinking all over the world, with over 500 brands and 2.2 billion servings per day. It has an unparalleled distribution network, a loyal customer base, and a powerful brand that is recognized and valued worldwide. According to Brand Finance, Coca-Cola's brand value was $97.9 billion in 2022, making it the most valuable soft drink brand in the world. An investor would be happily rewarded today if they had made an investment at the same price and time that Berkshire Hathaway bought its shares. At the time, a $500 investment could have bought 11 shares of Coca-Cola. Coca-Cola shares were divided 2-for-1 in 1990, 1992, 1996, and 2012. The $500 investment would have become 176 shares as a result of the stock splits. Based on the price at the time of this video, which was $63.75, the $500 investment would be worth $11,220 today, excluding dividends. Over the past years, the investment has increased by an astounding 2,244%, or an average annual return of 64.1%. Apple is another major holding of Berkshire Hathaway, with an initial investment made in 2016 and still holds today. The iPhone, iPad, Mac, Apple TV, Apple Music, and other cutting-edge offerings from Apple are popular with customers. The firm's moat includes its devoted client base, robust ecosystem, premium brand, and high switching costs. Switching to another brand would mean losing access to these products and services as well as the convenience and familiarity of using Apple devices. So customers are willing to pay a premium price for Apple products and are less sensitive to competitors' offers. This gives Apple a competitive advantage over other technology companies and allows it to maintain its market share and growth. Apple was the most valuable brand in the world in 2022 with a brand value of $263.4 billion.
You might think about picking out 5 or 10 companies where you feel quite familiar with their products, maybe, but not necessarily so familiar with their financials and all of that. But pick out something so at least you understand if you understand their products, you know what's going on in the business itself, and then get lots of annual reports and through the internet or something else, get all the magazine articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself as if you were either going to work for the company or they'd hired you as the CEO or you were going to buy the whole business. I mean, you can look at it in any of those ways. And when you get all through, ask yourself, what do I not know that I need to know? And back many years ago, I would go around and I would talk to competitors always. You'd talk to employees of the company and ask those kind of questions. That's in effect what I did with my friend Lorimer Davidson when I first met him at Geico, except I started from ground zero. But I just kept asking him questions. And that's what it really is. One of the questions I would ask if I were interested in the ABC company, I would go to the XYZ company and try and learn a lot about it. Now, there's spin on what you get, but you learn to discern it. Essentially, you're being a reporter. I mean, it's very much like journalism. And if you ask enough questions, Andy Grove has in his book, he talks about the silver bullet. You talk to the competitor and you say, if you had a silver bullet and you could only put it through the head of one of your competitors, which one would it be and why? Well, you'll learn a lot if you ask questions like that over time. And you ask somebody in the XYZ industry and you say, if you're going to go away for 10 years and you had to put all of your money into one of your competitors, the stock of one of your competitors, not your own, which one would it be and why? You just keep asking and asking and asking. And you'll have to discount the answers you get in certain ways, but you will be getting things poured into your head that then you can use to reformulate and do your own thinking about why you evaluate this business at this or that. The accounting, you just sort of have to labor your way through that. You may be able to take some courses even in that. But the biggest thing is to find out how businesses operate.
Management tenets are about the quality and integrity of the management team. Buffett looks for managers who are honest, intelligent, energetic, rational, shareholder-friendly, and resistant to institutional imperatives. Warren Buffett's financial tenets revolve around maintaining a strong financial position for his investments. He believes in keeping a conservative financial structure with low debt and high liquidity. This allows his company, Berkshire Hathaway, to be ready to take advantage of investment opportunities when they arise. Buffett emphasizes the importance of understanding the financial statements of a company, particularly its cash flow and return on equity when making investment decisions. He also stresses the importance of avoiding investing in businesses with unpredictable earnings, high capital requirements, and low returns on invested capital. Again, take Coca-Cola as an example. Coca-Cola has a strong financial performance and position that reflects its earning power and cash-generating ability. The company has an ROE of 40.5% as of 2022, well above the industry average of 18.9%. The company also has a cash flow higher than its net income, indicating that it does not rely on accounting adjustments or non-cash items to boost its earnings. The company has a low debt-to-equity ratio of 0.3 as of 2022, indicating that it has a conservative capital structure and high financial flexibility. The company's profit margin was 26.8% as of 2022, showing that it has high profitability and can retain or grow its earnings over time. The company's maintenance capital expenditure was $1.4 billion in 2022, which was only 7% of its operating cash flow of $20.6 billion, indicating that it does not need to invest heavily to maintain its current level of operations and profitability.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future.
Warren Buffett's value tenet is based on the principle of buying undervalued stocks that have a high intrinsic value. According to Buffett, an undervalued stock is one whose market price is lower than its intrinsic value. Intrinsic value is the estimated true value of the company based on its financials, management, competitive advantages, and growth prospects. Buffett believes that a company's intrinsic value is the most important factor to consider when buying stocks. To determine the intrinsic value, Buffett uses a variety of metrics, including earnings, book value, and cash flow. He also looks at the company's industry and competitive position to determine its future growth potential. By focusing on the intrinsic value, Buffett is able to find stocks that are trading at a discount to their true worth, providing a margin of safety for investors. One example of a margin of safety is Warren Buffett's investment in Coca-Cola in 1988. He bought 23 million shares for $1.02 billion when the market price was around $43 per share. He estimated the intrinsic value of Coca-Cola to be around $85 per share, based on its brand, customer loyalty, and cash flow. Therefore, he had a margin of safety of 50%, which means he paid only half of what he thought the company was worth. He believed that this margin of safety would protect him from any errors in his valuation or any adverse market conditions. This approach has helped Buffett generate significant returns over the years, and it continues to be a cornerstone of his investment strategy. According to Warren Buffett, share repurchasing is a good way to return value to shareholders when the stock price is below its intrinsic value and there are no better opportunities to invest the capital elsewhere. He also believes that share repurchase can increase the per-share earnings and book value of the remaining shares, as well as the ownership stake of the loyal shareholders who do not sell their shares. The benefit of share repurchase is enhancing the long-term value of the company and its shareholders by reducing the number of shares outstanding. He also considers share repurchase as a tax-efficient way to distribute cash to shareholders, compared to dividends which are subject to income tax. So Buffett repurchased nearly $3 billion of Berkshire Hathaway's stock in the current quarter, $6.6 billion of stock in the first quarter of 2021, and $24.7 billion in 2020, as he continued to see his own stock as undervalued, and the repurchasing of Berkshire Hathaway's shares was consistent with his own rule. We appreciate your watching. Please hit the like button below if this video helped you in any way, and don't forget to subscribe to the channel. Thanks again and see you next time.